You sign the papers with a smile, believing you've just secured your family's future. But what if that belief is the very thing putting it at risk? Sarah sat at the long wooden table, her hands trembling slightly as the loan officer slid the final page toward her. A 30-year mortgage on a 3-bedroom house in a suburb she'd never even visited until 6 months ago. She was 32, a marketing manager, and this was supposed to be the moment everything clicked into place. The American dream, wrapped in hardwood floors and a 2-car garage. Her father had told her 100 times, rent is throwing money away, but a house is an investment that always goes up. The monthly payment was higher than her rent had been, $2,400 instead of $1,650, but the bank approved her, and everyone said it was the smart move. What she didn't know, sitting in that beige office with motivational posters on the walls, was that she'd just locked herself into a machine designed in the 1930s, one that would quietly reshape the next decade of her life. The loan was structured so that for the first 10 years, most of her payment went to interest, not the house itself, meaning she was essentially renting from the bank while building almost no equity. She also owed property taxes, homeowner's insurance, and an HOA fee she hadn't budgeted for, adding another $600 a month to costs that never showed up in the sales pitch. Within 3 months, the water heater died, the roof started leaking, and the HVAC system made a noise like a dying animal. Repairs that cost her $8,000 she didn't have. She put it on a credit card, telling herself it was temporary, that homeownership was still building wealth, even as the numbers in her bank account told a different story. By the end of the first year, Sarah had spent $37,000 on housing, more than double what she'd paid in rent, and owned less than $3,000 worth of the house. If you found this video useful, please consider subscribing, liking, sharing, and leaving a comment. It helps the channel grow and allows us to continue producing documentary-style content like this. The idea that home ownership builds wealth wasn't born from economics. It was born from policy, specifically the National Housing Act of 1934, passed during the Great Depression to stabilize a collapsing economy. The government created the Federal Housing Administration to ensure long-term mortgages, which meant banks could lend to middle-class families without taking much risk. The taxpayer absorbed the risk instead. This turned housing into a financial product, something you could borrow against, sell, speculate on, and it worked for a while, when homes cost twice your annual income instead of 8 times. By the 1950s and 60s, millions of Americans bought homes with government-backed loans, low interest rates, and wages that were rising faster than home prices, a combination that no longer exists. The cultural narrative hardened into gospel. Renting was for suckers, home ownership was wealth, and if you didn't buy, you were financially irresponsible. A story that benefited banks, real estate agents, and construction companies far more than it benefited buyers. What changed was the financialization of housing. Once homes became retirement plans, investment vehicles, and collateral for loans, their prices stopped reflecting what people could afford and started reflecting what investors were willing to pay. Between 2000 and 2020, U.S. home prices rose 117%, while median household income rose only 20%, a gap that math alone says cannot continue forever. Yet the system continued, fueled by cheap credit, tax incentives for mortgage interest, and zoning laws that restricted supply, all policies designed to keep prices climbing because falling home prices meant financial disaster for banks and voters alike. Sarah, sitting at that closing table, wasn't buying a house. She was buying into a system that required her payments to keep the whole structure from collapsing. The tragedy was that she believed it was her choice. What surprised Sarah most wasn't the big expenses. It was the small ones that never stopped coming, the ones no one mentioned when they said homeownership was an investment. Lawn maintenance, pest control, gutter cleaning, driveway sealing, furnace inspections, each one minor, but together they added up to thousands of dollars a year that renters never paid. She also lost flexibility. When her company offered her a promotion in another city, she had to turn it down because selling the house would have meant losing money on realtor fees, closing costs, and a market that had softened since she bought. Her renting friends, meanwhile, moved freely. One took a job in Austin, another relocated for family reasons, a third downsized when they wanted to save money. The phrase "trapped in equity" didn't exist in the sales pitch, but it was real. Sarah had spent years paying into a house she couldn't afford to leave. Then there was the opportunity cost. The $50,000 she put into the down payment and repairs could have been invested in index funds, which historically returned 10% annually, compared to her home's 3% appreciation. She'd been told real estate always goes up, but in her neighborhood, prices had been flat for 4 years, not because of a crash, just because demand had shifted elsewhere. Even if she sold at a profit, after paying the 6% realtor commission, 2% closing costs, and capital gains taxes, her investment would barely break even with inflation. The real wealth, she realized, had been transferred, not to her, but to the bank that collected interest, the insurance company that charged premiums, and the county that assessed taxes. Homeownership hadn't made her wealthy. It had made her a revenue stream. 7 years after that closing, Sarah sat in her kitchen doing the math, really doing it this time, without the optimism or the narratives people had fed her. She'd paid $201,600 into the mortgage, but only owned $62,000 of the house. The rest had gone to interest, and she still owed $238,000 to the bank. Add in property taxes, insurance, HOA fees, maintenance, and repairs, and her total housing cost had been $328,000, enough to have rented a nicer place, invested the difference, and had 6 figures in liquid savings. The house hadn't appreciated much, maybe $40,000 on paper, but she couldn't access that money without selling, and selling meant starting the cycle over somewhere else. Her father's advice had been well-meaning but outdated. It came from an era when homes cost less, wages grew faster, and companies kept workers in one place for decades. That world was gone, replaced by one where housing had become financialized, mobility was essential, and the only guaranteed winners were institutions, not individuals. Sarah didn't regret having a home. She loved the space, the stability, the garden she'd planted, but she'd stopped pretending it was an investment. It was a lifestyle choice, an expensive one, and that was fine, as long as she was honest about what it cost. The safe bet, she realized, wasn't the house. It was the freedom to choose where your money went, what risks you took, and whether you were building wealth or just feeding a system. And sometimes the smartest move was questioning the very thing everyone told you was safe.